Welcome to this explainer. Today we're going to tackle that incredibly stressful moment at the insurance counter and figure out, once and for all, exactly what auto coverage you actually need. Look, auto insurance premiums have been rising like crazy lately. And for a lot of us, especially if you're nearing retirement or already managing a fixed income, that monthly bill feels like a tighter and tighter squeeze. We've all been there, right? Sitting across from an agent or just clicking endlessly through an online quote. It's confusing, it's expensive, and honestly, when you're trying to protect a carefully planned household budget, it's just incredibly frustrating.
So it all boils down to the ultimate question you face at renewal time: liability only or full coverage? Getting this wrong means you're either throwing hard-earned money down the drain month after month, or even worse, finding yourself with absolutely zero financial protection when the unexpected happens. When you've spent decades building up your savings, a single mistake on your auto policy shouldn't be the thing that drains your bank account. There's already a huge emotional toll when an accident happens. True peace of mind comes from knowing exactly what your policy does and doesn't cover long before you ever hear the crunch of metal.
All right, here's our roadmap for today. We'll cover 1. The dilemma, 2. Core definitions, 3. Crash scenarios, 4. Decision factors, 5. Renewal mistakes, and 6. Final choice. Let's jump right in.
Section 1. The dilemma.
Okay, the absolute baseline difference between these two options is actually pretty simple, but man, is it misunderstood. Liability insurance is strictly about other people. It covers the medical bills and the property damage you cause to others when you're at fault in a wreck. Full coverage, on the other hand, is what actually protects your own car. Imagine that terrible sinking feeling of causing an accident, calling your insurance company and finding out that because you only carried liability, they aren't going to pay a single dime toward repairing or replacing your vehicle. You're left to just absorb that massive loss completely out of pocket.
Moving on to Section 2, Core Definitions.
You know what's really interesting about full coverage? It isn't actually a single product. A lot of times, insurance agents will sell it as one big package, which just adds to the confusion. In reality, it's a bundle of 3 distinct protections working together. First, you've got liability, which, like we just said, pays others. Second is collision, which covers damage to your vehicle when you hit another car or, say, a guardrail, no matter who is at fault. And third is comprehensive. Think of comprehensive as your wildcard coverage. It handles theft, fire, hail, or a massive tree branch smashing your windshield during a storm.
Have you ever stared at your policy and seen 3 random numbers like 25, 50, 25? Let's decode that real quick. That first number is the maximum payout in thousands per injured person, so $25,000. The second number is the maximum payout per accident for all injuries combined, and the third is the max for property damage. Now, every state sets its own required minimums for these limits, but honestly, those minimums are often dangerously low. If you've spent your life building up significant assets, carrying only state minimums is extremely risky. A lawsuit from a bad accident that blows past those low limits can easily come after your home or your hard-earned retirement portfolio.
All right, let's make this real. Section 3. Crash scenarios. Picture this. It's a freezing winter morning. You slide on a totally unexpected patch of black ice and boom, you hit a utility pole. The good news, nobody else is involved and you aren't hurt. The bad news, your vehicle, your primary way of getting to work, running essential errands, visiting the grandkids, is completely destroyed, totaled right there on the side of the road.
If you have a liability-only policy, the insurance company hands you absolutely $0 for your car in this scenario. Nothing. You get zero help replacing that vehicle. But under a full coverage bundle, the collision part of your policy kicks in. They'll pay to replace your vehicle at its current market value minus your deductible. It's literally the difference between walking away completely empty-handed versus getting a check so you can immediately go buy a replacement and get back to your normal routine.
Now, let's imagine an event that is totally out of your control. We're talking random acts of nature that you can't prevent no matter how good of a driver you are. Maybe you live down in Florida and a sudden hurricane rolls through, floods your driveway, and ruins your engine. Or maybe you're driving home at dusk and a deer jumps right out of the woods into your headlights.
Without the comprehensive portion of a full coverage bundle, you're flying without a net against these wild cards. You pay for all of that sudden damage entirely out of your own pocket. But with full coverage, comprehensive steps right in. It covers those heavy repair bills or replaces the vehicle entirely after a flood or an animal strike.
I want to slow down here for a second because this is where the rubber really meets the road for our savings. Consider this insight from James Sabb, an expert with 30 years in the business. He noted a truly tragic pattern. Folks carrying liability only to save maybe $80 a month, but they're driving cars worth $15,000. Think about that. The math of saving a little bit monthly just to expose yourself to a massive $15,000 hit to your retirement savings?
Yeah, that never works in your favor.
Which brings us to Section 4, Decision Factors.
So how do you decide? First, look at what your car is actually worth right now. If its market value is under $4,000, liability only might actually make financial sense. Why? Well, if the car gets totaled, the payout you'd get barely covers the annual cost of the full coverage policy. Remember, you have to subtract your deductible, which could be $500 or even $1,000, from that $4,000 payout. By the time you subtract the deductible and factor in paying higher monthly premiums, keeping full coverage on a low-value car turns into a losing financial equation pretty fast.
On the flip side, if your car is worth over $8,000, full coverage is almost always justified. Losing an $8,000, $10,000, or $20,000 asset overnight, that would severely strain almost anyone's budget. And hey, keep in mind that in today's used car market, older vehicles are often worth way more than people think. You might actually be sitting on an $8,000 asset right now without even realizing it. Paying that premium is absolutely worth it to prevent a massive financial shock.
Now ask yourself about this number range, $5,000 to $10,000. That represents the accessible cash savings you'd need to instantly buy a reliable replacement car. If you're nearing retirement or living on a fixed income, draining $5 to $10 grand from your hard-earned nest egg for a surprise expense is exactly the kind of thing insurance is meant to prevent. If you don't have that kind of cash just sitting around comfortably, you definitely need full coverage acting as your financial buffer.
Oh, and a quick but super important reminder here. If your car is currently financed or leased, this isn't even a choice. Your lender absolutely requires you to carry full coverage to protect their investment. Dropping it actually violates your loan agreement. And if you do drop it, the lender will force their own insurance onto your bill. Let me tell you, force-placed insurance is notoriously expensive, and it only protects them, not you.
All right, Section 5, Renewal Mistakes.
There are 3 big traps to watch out for when it's time to renew. Number 1, carrying only state minimum limits. A $25,000 limit vanishes in a heartbeat in a multi-car accident, leaving your personal assets totally vulnerable. Number 2, choosing a sky-high deductible, like $1,500, just to lower your monthly bill. That only makes sense if you actually have $1,500 sitting in the bank ready to go when an accident happens. And number 3, not updating coverage as your car ages. Many of us keep reliable cars for a decade or more. You need to review your policy every year so you aren't overpaying for full coverage on a vehicle that is heavily depreciated.
And finally, Section 6, Final Choice.
Here is the absolute bottom line we want you to take away today. Liability coverage is the legal floor. It's just what keeps you legal to drive on the road. Full coverage is the financial safety net that protects your household budget and your peace of mind. Neither choice is universally right for everyone. It completely depends on what your car is worth today and what you have readily available in your savings account.
I want to leave you with this final, provocative thought to help you evaluate your own situation. If your car was totaled tomorrow morning, would it just be an annoying inconvenience, or would it be a severe financial disaster for your family? Take 10 minutes to look at your policy today. Run the simple math we just covered, and make absolutely sure your coverage matches the reality of where you are in life right now. Thanks so much for joining me on this explainer, and stay protected out there.